Imagine this. You're in your late 20s or early 30s. You've spent years doing everything people told you was the right thing to do. You went to school, got a job, showed up every day, worked hard, and tried to be responsible with your money. Maybe you've even built up a decent savings account. Not enough to retire, of course, but enough to feel like you're finally making progress. Then one day, you decide it's time to buy a house. You open a mortgage calculator and start running the numbers. At first, you're excited. This feels like the next step, the step that officially proves you've made it. But then reality hits. The monthly payment is far higher than you expected. Home prices have climbed. Interest rates aren't what they used to be. Suddenly, the house you thought you could afford is completely out of reach. That's when someone presents a solution. Don't worry, we can make the payment lower. Instead of a 30-year mortgage, they offer you 40 years, maybe even 50 years. And just like that, the payment drops enough to fit your budget. It feels like a victory. It feels like you've found a loophole. But here's the thing. The payment got smaller. The debt didn't. In fact, the amount of interest you'll pay over your lifetime may have just exploded. And what looks like a solution today could quietly become the reason you stay in debt for most of your adult life. And that's exactly why we need to talk about the 50-year mortgage trap. My name is Demas, and I spend way too much time thinking about money. If you're someone who feels stuck financially, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Now, let's talk about something that almost nobody is paying attention to. Because when people discuss the housing market, they usually focus on home prices, mortgage rates, or whether now is a good time to buy. But very few people stop and ask a much more important question. What happens when debt becomes a permanent part of your life? Here's the thing. For most people, a mortgage isn't just another monthly bill. It's the single largest financial obligation they'll ever take on. It influences where they live, how much they can save, when they can retire, and even how much risk they can take in their careers. And yet many buyers spend more time researching their next smartphone than they do understanding the structure of a mortgage that could follow them for half a century. Look, a 50-year mortgage sounds harmless. In fact, it sounds helpful. Lower payments, easier approval, less pressure every month. But financial decisions should never be judged only by how they feel today. They should be judged by what they do to your future. And once we break down the numbers, the psychology, and the hidden incentives behind these ultra-long mortgages, you'll understand why what looks like a solution may actually be one of the biggest wealth traps ever created. Most people grow up believing that buying a home is one of the smartest financial decisions they'll ever make. And honestly, that's not entirely wrong. For decades, home ownership has been associated with stability, financial security, and long-term wealth creation. Parents tell their kids to buy a house. Financial advisors recommend building equity. Society treats home ownership as a major milestone of success. So naturally, when someone is finally ready to buy a home, the decision feels obvious. Buy the house, make the payments, build wealth. End of story. But here's where things start to get complicated. Because a house and a mortgage are not the same thing. A house is an asset. A mortgage is a liability. And far too many people focus on the asset while completely ignoring the liability attached to it. Look, if two people buy the exact same house but finance it differently, they can end up with dramatically different financial outcomes over time. Yet most buyers never think about that. Instead, they ask one simple question. Can I afford the monthly payment? That's it. Not, how much interest will I pay? Not, what is the total cost of ownership? Not, how will this affect my ability to invest for retirement? Just the monthly payment. And that's exactly why longer mortgages have become so appealing. Because when lenders advertise affordability, they're rarely talking about total cost. They're talking about monthly payments. Here's a simple analogy. Imagine walking into a dealership to buy a car. The car costs $50,000. But instead of discussing the price, the salesperson only talks about the monthly payment. Then they stretch the loan from 5 years to 10 years. Suddenly, the payment looks affordable. You feel like you're getting a great deal, but the car didn't become cheaper. The timeline simply became longer. And the same thing happens in housing. A lower payment creates the illusion of affordability, but affordability and financial freedom are not always the same thing. And that's the distinction most buyers never stop to consider. So how did we get here? Why are lenders and policymakers even talking about 40-year and 50-year mortgages in the first place? The answer is actually pretty simple. Homes have become dramatically more expensive. Over the past decade, housing prices in many parts of the country have risen much faster than wages. At the same time, mortgage rates increased significantly compared to the ultra-low rates people enjoyed just a few years ago. As a result, the monthly payment required to buy an average home has skyrocketed. For many families, the dream of homeownership suddenly feels out of reach. And when affordability becomes a problem, the market looks for solutions. That's where longer mortgages enter the picture. Because from a lender's perspective, extending a loan term is one of the easiest ways to lower a monthly payment without reducing the price of the home. Look, imagine you're trying to carry a heavy box. One option is to make the box lighter. The other option is to carry it for a longer distance. A 50-year mortgage doesn't make the financial burden lighter. It simply spreads the burden across more years. And at first glance, that seems like a great deal. A payment that was once too high suddenly becomes manageable. A buyer who couldn't qualify before may now qualify. The house that seemed impossible suddenly feels attainable. Now you might be thinking, isn't that a good thing? In the short term, absolutely. More people gain access to home ownership. More buyers can enter the market. But here's what most people don't realize. The lower monthly payment is only solving the symptom. It's not solving the underlying problem. The house is still expensive. The debt is still enormous. The interest is still accumulating. And while the payment feels smaller today, the financial commitment may now follow you for the next 50 years. That's not just a mortgage. That's a lifetime subscription to debt. And before you sign up for something that lasts half a century, it's worth understanding exactly what that decision is going to cost you. Now let's look at the numbers, because this is where the entire conversation changes. A lot of financial decisions sound reasonable until you actually put them into a calculator. Let's imagine you're buying a home and borrowing $400,000 at a 6.5% interest rate. At first, a 50-year mortgage looks incredibly attractive because the monthly payment is lower than a traditional 30-year mortgage. That's the part everyone notices. A few $100s saved every month can feel life-changing, especially when money is tight. But here's what most people don't realize. The bank isn't lowering the cost of the house. The bank is simply giving interest more time to work against you. Think about it this way. Interest is like renting money. The longer you rent it, the more you pay. A 30-year mortgage already generates hundreds of thousands of dollars in interest over its lifetime. When you stretch that same loan to 40 or 50 years, you're dramatically increasing the amount of time interest has to accumulate. Suddenly, what looked like a small monthly savings turns into a massive long-term expense. And here's the shocking part. In many cases, the extra interest paid over the life of a 50-year mortgage can approach or even exceed the amount you originally borrowed. Read that again. You borrow $400,000. Yet over time, you could end up paying hundreds of thousands of dollars more just in interest. This is where it gets really interesting. Most buyers focus on what the house costs each month. Wealthy people focus on what the house costs in total. Those are two very different perspectives. One asks, can I make the payment? The other asks, how much of my future income am I giving away? And when you start looking at mortgages through that lens, the 50-year option begins to look a lot less like financial freedom and a lot more like a very expensive compromise. At this point, you might be wondering something. If the math is so unfavorable, why do so many people still choose longer loans? The answer has very little to do with mathematics and almost everything to do with human psychology. Because here's the thing. People don't experience financial decisions as spreadsheets. They experience them as emotions. When someone sees a mortgage payment that's too high, they immediately feel stress, anxiety, uncertainty, maybe even fear. Then a lender offers a lower payment. Instantly, that stress starts to disappear, and that's where the trap begins. Behavioral economists call this instant gratification. Humans naturally place a higher value on rewards they can enjoy today than benefits they might receive years from now. A lower payment creates immediate relief. The extra interest doesn't feel real because it's decades away. Future you pays the price. Present you gets the reward. And our brains are surprisingly willing to make that trade. But that's not the only psychological force at work. There's also something called loss aversion. Research has consistently shown that people feel the pain of a loss much more intensely than the pleasure of an equivalent gain. In simple terms, losing $100 hurts more than gaining $100 feels good. So, when buyers see a large mortgage payment, their brain interprets it as a loss. Reducing that payment feels like avoiding pain, even if the long-term cost becomes much higher. This is where it gets really interesting. Most people believe they're making a rational financial decision, but often they're simply choosing the option that feels emotionally comfortable in the moment. And lenders understand this perfectly. That's why advertisements rarely focus on total interest paid over 50 years. They focus on monthly affordability, because monthly affordability triggers emotions. Total cost requires calculation, and emotion almost always wins when people make financial decisions. That's why understanding your psychology is just as important as understanding the math. Because sometimes the most expensive financial decisions are the ones that feel the most comfortable today. So, if longer mortgages are often expensive, how do wealthy people think about this differently? Well, here's something that completely changed the way I look at money. Most people evaluate financial decisions based on whether they can afford the monthly payment. Wealthy people evaluate financial decisions based on how those decisions affect their net worth over time. That may sound like a small difference, but it's actually enormous. Look, when the average person sees a house, they think about the payment. When a wealthy investor sees a house, they think about opportunity cost, cash flow, risk, and long-term returns. They're asking completely different questions. Instead of asking, "Can I afford this house?" they're asking, "What is this house preventing me from doing with my money?" Here's what most people don't realize. Every dollar committed to debt is a dollar that can't be used somewhere else. It can't be invested. It can't be used to start a business. It can't be used to build additional income streams. It can't be used to create future opportunities. This is where it gets really interesting. Wealthy people understand that money is valuable not just because of what it buys today, but because of what it can become tomorrow. A dollar invested productively has the potential to grow. A dollar spent on unnecessary interest is gone forever. That's why many wealthy individuals focus obsessively on efficiency. Not because they're cheap, but because they understand compounding. Compounding works like a snowball rolling down a hill. At first, growth seems slow. Then over time, the snowball becomes massive. The same principle applies to wealth. Small advantages repeated over decades create extraordinary outcomes. Small mistakes repeated over decades create extraordinary costs. And that's exactly why a 50-year mortgage deserves careful attention. Because the real danger isn't the monthly payment. The real danger is the opportunity cost hidden behind it. Every extra dollar spent on interest is money that could have been growing for you instead. And over the course of 30, 40, or 50 years, that difference can become life-changing. That's the perspective many wealthy people understand. They don't just ask what something costs. They ask what it's costing them to own it. But here's the hidden insight that almost nobody talks about. The biggest danger of a 50-year mortgage isn't the interest. It's the loss of flexibility. And flexibility is one of the most valuable financial assets you can ever have. Think about it. When people imagine their future, they usually assume everything will go according to plan. They'll keep their job, their income will continue growing, and life will remain relatively stable. But reality rarely works that way. Life is unpredictable. People lose jobs, industries change, businesses fail, unexpected medical expenses happen, families grow, relationships change, entire economies go through recessions. Now imagine carrying the same mortgage through all of that. A 50-year mortgage isn't just a loan. It's a financial commitment that could potentially stay with you for most of your adult life. And the longer an obligation exists, the more opportunities there are for something to go wrong. Here's the thing. Financial freedom isn't simply about having a high income. It's about having options. The ability to walk away from a toxic job. The ability to take a career risk. The ability to start a business. The ability to take time off when life demands it. Those options become much harder when a significant portion of your future income is already spoken for. This is where wealthy people often think differently. They don't just focus on maximizing returns. They focus on maximizing optionality. Because optionality creates resilience. A person with lower fixed obligations can adapt more easily when circumstances change. A person carrying decades of debt has less room to maneuver. Look, a mortgage should support your life. Your life shouldn't be organized around supporting a mortgage. And that's why the true cost of a 50-year loan isn't only measured in dollars. It's measured in opportunities you may never be able to pursue because too much of your future has already been committed. That's the hidden price most people never calculate. And in many cases, it's far more expensive than the interest itself. So what should you actually do if you're thinking about buying a home? First, stop asking only one question. Don't ask, can I afford the monthly payment? Ask, what is the total cost of this decision? Because those are not the same thing. A payment can fit comfortably into your budget and still be a poor financial decision over the long run. Look beyond the monthly number. Consider the total interest, property taxes, insurance, maintenance costs, and how the mortgage will affect your ability to save and invest. Second, leave yourself room to breathe. One of the biggest mistakes people make is buying the most expensive home a bank will approve them for. Remember, the bank's goal is to determine how much debt you can carry. Your goal should be to maximize financial freedom. Those are two very different objectives. Third, continue investing even while paying down your mortgage. Because wealth is built through ownership of appreciating assets, not simply through making debt payments. And finally, if you choose a longer mortgage, don't treat the minimum payment as the only payment. Whenever possible, make additional principal payments. Even small extra payments can save tens of thousands of dollars in interest over time. Now here's the final takeaway. The 50-year mortgage isn't evil. It's not a scam. It's simply a financial tool. But every financial tool comes with trade-offs. The problem is that most people only see the benefit. They see the lower monthly payment. They don't see the decades of additional obligations hiding behind it. Here's the thing. Building wealth has never been about making the biggest purchase possible. It's about creating flexibility, building assets, and gradually increasing the percentage of your income that belongs to you. Not the bank, not your lenders, you. Because at the end of the day, financial freedom isn't measured by the size of your house. It's measured by the amount of control you have over your future. And before signing any mortgage that could last half a century, ask yourself one simple question. Is this helping me build wealth? Or is it simply helping me stay comfortable with debt? The answer to that question may completely change the direction of your financial future, and that's something worth thinking about.